I'd like to welcome our new sponsor, Rothschild Capital Solutions. Rothschild is a commercial investment banker and direct lender. The company targets well-located assets for value-add investment primarily in the Midwest and the Southeast. Rothschild is positioned to invest up to $35 million per deal. They may be just the partner or lender you've been looking for to turn your deals, even the most aspiring, into reality. Need capitalization beyond a debt financing loan? Rothschild gives you a full set of options: JV equity, bridge, preferred equity, mezzanine, development and construction. What do you need? The chances are Rothschild can provide it, as well as the experts to make the deal real. Click on the banner below the show to contact Gary Williams now. You've got the deal, Gary's got the backing you need. Click now. Hello and happy Wednesday, November 25th. Welcome back to another exciting edition of Rate Desk. I am your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, let me start and say happy holidays to everybody, because we are entering that holiday season, and I wish you and your loved ones a good holiday season. Jumping on over to the markets today, they are a bit mixed. They've cooled down. They had a bit of a run up in a couple of the indices, and then they've cooled off today. We got some economic news regarding unemployment numbers going up. So I heard a quote, saw a quote from Ben Bernanke, former Fed chair, and I really liked it because he talked about this recession is going down in an elevator and then taking the stairs up. And I feel like that's what it's been like. When things drop, they drop very suddenly, and then we kind of got to climb back up. So we do see a bit of a mixed message. The Dow is on track for the best month since 1987. Hard to believe, but both the Dow and the S&P 500 were down a little bit on the session today on that news. NASDAQ is also close to breaking some records. Other positive news saw the crude oil up in the $45 barrel range. Have not seen it that high for quite some time. Very kind of nice to see that, actually. Jumping over to the U.S. 10-year Treasury yield, basically range bound to last week, a couple basis points up, 0.89, trading 89 basis points today. Going on over to the multifamily rates, HUD FHA is flat to last week. 223F rates on the 35-year fixed are at 239, that is 239. Jumping on over to the 221D for 40-year fixed rate. New construction sub-rehab 299. Still got a 2 handle, but just barely. So flat to last week. Jumping over to agencies, spoke with my friend John Hinder at Walker Dunlop, and we were discussing how pricing has moved up this week about 10 basis points. There's a little uncertainty as they're going through their pricing for 2021. He expects to see it settle down a bit more in January. So that said, jumping on over to the Fannie Mae rate, 10 bips up from last week, so that's 304. That is fixed for 10 years. And on Freddie Mac, we're looking at 340, 3.40. That is also fixed for 10 years. Jumping into other news, if you haven't locked your rates already, we're entering that time of year where some of the buyers of instruments, particularly FHA, which uses Ginnie Mae underlying certificates, those are sold. A lot of the Wall Street buyers have really filled up their baskets this year due to the record volume of new HUD loans, FHA loans. It's always a desirable form of investment. You know, they're basically traded like government securities because they are guaranteed by the FHA. So, a lot of that buying does tend to slow down towards the end of the year. Also spoke with a debt fund I do business with, and they are in fundraising mode now. So they've depleted all of their capital for loans, and now they've got to go raise more money. So we are entering that twilight time for this year on funding. However, if you've got a deal and you're in the midst of a rate lock, or you've rate locked, you're probably good to go, to close it out. But the rest of us that have deals, we're really looking now at the Q1 of next year. So interesting move that kind of shifts and happens in finance towards the end of the year. A couple of things I wanted to mention too. Read a little bit more into that Ben Bernanke interview from some top housing folks in our industry, and he's talking about affordable housing. And from his point of view, the day one in economics, you learn that if you increase the supply of something, the price goes down. Well, wow, wouldn't that be neat if we could just flip a switch on and just increase our housing supply? We know we need more rental housing. Just in general, we need more housing. We need more housing, we need more rental housing, and then of course we need more affordable housing and workforce housing. Big needs there. Didn't have any secret sauce, that was disappointing. However, he did mention, if we can cut some more red tape with local governments working in tandem, so kind of one of those partnerships, triple P, private partnership with the public, and trying to get together here and make it a little easier to develop with the zoning and some of the restrictions that you have to go through as a developer. Again, that's no secret sauce. Certainly, NAHB and many of the large associations in our housing industry have advocated for stuff like that for quite a long time to expedite the process and make it easier. But that is, I just thought that was an interesting take on it from an economic perspective, because clearly, if you do find ways to either incentivize or somehow make it easier to develop or less costly to do so, that would be great, because you would actually increase the supply, and that would have the intended effect a lot better than trying to preserve or rent control or some of these things. They're just not enough of those opportunities really to meet the need that we have for housing. But always great to read a couple quotes from somebody that's a top mind in our country talking about issues that directly impact housing. That said, on the affordable front, there are some challenges and headwinds with the deeply affordable. Obviously, they've been hit extremely hard in this downturn. So again, that's a sector that I think is going to be looking to innovate and to find new ways to support that type of development going forward in the future. I think we've all learned a lot about housing and about income in these times, and I really look forward to seeing some brainstorming sessions next year and some of the affordable housing groups that I'm involved with. Of course, I'll share any good tidbits here on the show, but always looking for new ways to approach and solve these types of challenges we face. And it's an industry rife with challenges, right? It's almost, you could say, we specialize in overcoming challenges more than anything. But that is all for I have today. And I thank you all so much for tuning in to another exciting edition of Rate Desk. I am your host, Michael Thomas, signing off.